In nature, ant colonies work together to do things that no single ant could, like building bridges out of their bodies and move across leaves to get food. The institutional buy-side, institutional investment funds, it all exists for the same reason, to pull together money from lots and lots of people to make the kinds of investments that no person could do alone. For example, Norway's government pension fund Global, which has about $1.7 trillion, owns about 1.5% of every company whose stocks are traded out there. And it costs a ton of money to buy all those stocks. But anyone who has just a little money in this fund gets to, in a way, invest in all these companies. But to pull money from thousands and thousands of people like this, you need to have some kind of proof for the people that put money in there saying, hey, I put in this much, therefore I own this percentage of the whole thing. I'm going to take this much of the money made from this. You need the idea of slices of ownership. You need shares. The Dutch East India Company was founded in 1602 by a group of Amsterdam traders organized by the Dutch government's chief minister Johan van Oldenbarnevelt. See, voyages to Asia could make a ton of money. Things like nutmeg and pepper were worth so much money when it was sold in Europe, but they cost almost nothing to be grown in Asia. It was really cheap to grow these things. So there was huge profit to be made there. But you had to put in a lot of money to do this kind of business, to do this kind of investment. The ship alone was a 400-ton warship. It costs about 60,000 Dutch guilders, which is like $10 million today. And then you have to pay for a crew of 200 to 300 men who need to be paid for 2 or more years at sea away from their families, plus their food and weapons. There's fighting off pirates and dealing with storms. It costs a lot of money. The individual Dutch person, even a rich Dutch person at the time, was nowhere near rich enough to do these highly profitable Asian trading voyages alone. And even if they were rich enough, if the ship were to sink, all that money that they put in was gone. Are you willing to take that risk? So Van Oldenbarnevelt had the idea to get the money to pay for the ships and the crew from thousands of people, and in turn, the profits from the Asian voyage would be distributed among all these people. The more money you'd put into it, the more money you'd get out of it. This was done by giving people shares in the company. The Amsterdam Stock Exchange was opened that same year to provide a physical place where people could buy and sell these shares. So let's say one person regretted buying a share. They actually now think that the ship is going to sink, and he wanted to get rid of his share now. Someone who was optimistic about this Asian voyage making money could go to the exchange and buy his share from him. As more and more companies started selling their own shares, you could start to own parts of a bunch of different companies. In other words, you can have stock or equity in a bunch of different companies. You could even own pieces of loans to different companies. You could own pieces of loans to different governments, and you can collect interest off these loans. These pieces of loans are known as bonds. So you can buy all these stocks and bonds along with gold, silver, Bitcoin, all kinds of investments. So if one ship sank, both literally or metaphorically, you didn't lose everything. And this is why we have portfolios. But the more things out there that you can invest in, the harder it gets to know what you should invest in. So people started paying experts to make their investments for them. People who spent their lives and careers studying how to make good investments so they can make a really great portfolio for you and all the other people who put their money with them. The people who do this are known as the institutional buy side. They're known as the buy side because they take the money that people give to them and then they buy a bunch of investments with them. As opposed to people who are trying to help companies sell their shares in their bonds, trying to help companies get their shares out there and their bonds out there. That's known as the sell side, but we won't go into that in this video. Now, it is a big responsibility to invest money on behalf of people. People could lose a lot of money. And there was a time when people thought you should be able to sue your fund manager for losing money, which could have killed the institutional buy side as we know it. In 1830, a portfolio worth $50,000, about $1.5 million of today's money, was left by Boston businessman John McLean for his wife. Now, John McLean nor his wife had the time or expertise to make investments with this money, so it had a fund manager. And this fund manager put the money almost entirely in company stocks, which are a little riskier than bonds. So stocks can make more money than bonds, but they can also lose more money than bonds. When Mrs. McLean died and the fund was given to its next heir, Harvard College, it was only worth $29,000 because the stocks went down a lot. Harvard College was not happy, so they sued the fund manager, arguing that the fund manager had a duty to make sure the fund didn't lose any money, and that a fund manager should only be allowed to invest in very, very safe investments like government bonds, which typically never lose money. However, you can't make nearly as much from them as company stocks. But Harvard lost the court battle because the court decided that day that fund managers need the freedom to make the investments that they think are the best for the portfolio. Had Harvard won this court battle, institutional investors would only be able to invest in government bonds, and the institutional buy side would look much, much different, and frankly a lot more boring than it is today. Now, although today's fund managers don't get sued for losing people's money, no one likes losing money. And if you are a portfolio manager that's known for losing people's money, people aren't going to pay you to manage their money, and you're not going to have much of a career left. So if you're a fund manager on the institutional buy side, the question on your mind every day is, what should I invest in? Now, the question of what's the best possible way to invest your money has been a heated discussion in the finance community for quite some time. Alfred Cowles III was the heir to the Chicago Tribune newspaper family. While recovering from tuberculosis in Colorado Springs, he had a lot of time on his hands, and he spent it reading stock recommendations put out by financial advice newsletters, paid subscription newspapers that told people which stocks to buy. Now, he grew a suspicion that these guys who called themselves professional market analysts and professional stock forecasters were really just guessing and gambling at the end of the day. He bet that they couldn't really beat the market. That is, that all their stock picks and all their trading couldn't make more money than just buying a piece of every company and doing nothing. So, Cowles collected all the published stock recommendations from 16 financial services companies over 4 years and saw whether they beat the market. His 1933 paper in the journal Econometrica, humorously titled "Can Stock Market Forecasters Forecast?", found that no one could consistently beat the market, and that the best performers were the best out of pure chance. Until then, active management, the idea of an expert hand-picking stocks and constantly doing all kinds of trades to beat the market, it wasn't really questioned. People thought that, well, with enough research, with enough experience, an expert would know the right stocks to pick to beat the market. The same way an experienced chef knows the right ingredients to use in a dish. But Cowles had people starting to question that. A couple years later, in 1936, John Maynard Keynes, one of the most notable economists of all time, describes in his famous paper, The General Theory, just how impossible it is to beat the market. He says, professional investment may be likened to those newspaper competitions in which the competitors have to pick out of the 6 prettiest faces from 100 photographs, the prize being awarded to the competitor whose choice most nearly corresponds to the average preferences of the competitors as a whole. We have reached the 3rd degree where we devote our intelligences to anticipating what average opinion expects the average opinion to be. Essentially, investors are trying to guess what investors think investors are going to do. So beating the market means outguessing everyone else's guess about what everyone will guess. Good luck. To add to the movement against active management, in 1952, Harry Markowitz, a 25-year-old PhD student at the University of Chicago, in a 19-page paper in the Journal of Finance, mathematically proved that owning a different mix of investments that didn't all go up and down at the same time, like having oil companies and airline companies which tend to move in opposite directions, this reduces the risk of your portfolio going down a lot without lowering the gain in your portfolio. You can get the same profits with a lot less chance of losing everything all at once, just by spreading your money across a lot of different things, by spreading your money across the whole market. This pointed even more towards the idea of just owning everything and doing nothing. 2 decades later, in 1976, fund manager Jack Bogle launches the first publicly available index fund at Vanguard. This was this new kind of fund that anyone could buy into that owns a little bit of everything and does nothing. He had quite an ambitious target of raising $150 million, but he only raised about $11.3 million. Wall Street laughed at Bogle, calling the index fund Bogle's folly. But Bogle had the last laugh, as he was proven more right than perhaps even he thought he was. And now, Vanguard manages about $8 trillion in people's savings. And by 2024, index funds, also known as passive funds, hold $21.8 trillion. Now, a fund can be used for a lot of different purposes, which is why there are many different types of funds. So let's get into these. First, there's pensions. The pension is almost as old as armies. Roman soldiers who survived 25 years of service were given plots of farmland so they'd have sustained income after they stopped fighting. The sustained, kind of consistent income would come from growing plants and maintaining livestock. Now, companies essentially do the same thing for their employees by consistently paying them after they retire with the returns of a big investment fund. Then there's endowments. In the Middle Ages, wealthy nobles and kings often donated land to the Catholic Church, and they did so because they believed the church would pray for their souls after death, reducing their time in purgatory before ascending to heaven. And instead of selling the land to get a bunch of money now, the churches kept the land as an investment, and they collected rent from the people living there every year and used that to keep running the church. So instead of getting a bunch of money now from just selling all the land, they could keep the land as an investment and through rent have money to run the church, well, theoretically, forever. Today's universities often do the same thing. They get lots and lots of money from these gifts from wealthy alumni, corporations, charities. But instead of using all that money right away, they invest it in a big fund to keep getting returns and to use those returns to keep the school running. Now, it's important to note that a few decades ago, some big things happened in the world of university endowments. In 1985, an up-and-coming Wall Street guy named David Swensen took over Yale's university endowment. At the time, it was worth $1.3 billion, and it was only invested in stocks and bonds. Swensen, though, completely changed up the portfolio to have a lot of illiquid investments. These are things that not just anyone can invest in, like private companies that don't offer shares to the public, real estate, and physical infrastructure like toll roads, airports, and cell towers. On the bet that there were more opportunities in these kind of closed-off investments since other investors couldn't beat him to it. And by his death in 2021, the endowment had reached $41.9 billion, generating a 13.7% return annually over 36 years, outperforming the average endowment by an average of 3.4% each year. We're going to talk a lot about private markets later in this video. Of course, we have insurance. In 1688, ship captains would like to get their coffee at Lloyd's Coffee House in London. Also in that coffee house were wealthy investors looking for ways to make some money. Someday, a ship owner would walk up to one of these wealthy investors and make a deal. I'm sailing to the Caribbean next month. I'll pay you £500 now if you agree to give me £10,000 if my ship sinks. The investor, if he thought the trip was most likely to succeed, would agree, as he was much more likely to make £500 right now than lose £10,000. And if he lost £10,000, it wouldn't be absolutely devastating to his wealth, at least in the same way that it would be for the captain. Now, the wealthy investors would make the same kind of deal with even more sailors, so that all these little £500 upfront investments of the captains who didn't have their ship sink would cover the £10,000 payment the investor would have to make to the captain whose ship sank. And then there would still be money from the £500 upfront payments on top of that, letting the investor make a profit. And Lloyd's Coffee House became the place where everyone came to make these kinds of deals. And eventually it became Lloyd's of London, which is still the world's most famous insurance market today. And the wealthy investor I just described is essentially the insurance company of today. It collects small, regular payments from a lot of people, and if something bad happens to one of them, like their house burns down, the insurance company pays them a lot of money. But because they collect so much money, they still make money. Especially because they invest all that money in the meantime to make more money. It's important to note that because a house can burn down anytime, insurance companies invest their collected money in things that they can quickly sell and quickly get cash from, like short-term government bonds, so that they can pay for these damages. Then we have sovereign wealth funds. When a country finds out that it's sitting on a very valuable natural resource like oil, it could sell that resource and make a ton of money right now. But if it does that, it might not have any money later. And moreover, the country would have too much cash to spend now anyway. And so, instead of cashing out right away, the government chooses to invest this money so that it can keep making more money, theoretically forever. It's like the endowment model I described earlier, but instead of a wealthy alumni giving a gift, the gift is the oil that the country just found under the ground. Kuwait in 1953 was one of the first countries to do this, to do a sovereign wealth fund. After finding hundreds of billions of dollars worth of oil, they decided to set a lot of that money aside and invest it, so the country wouldn't be broke when the oil ran out. Today, all that invested money is known as the Kuwait Investment Authority, which is currently worth about $800 billion. I think hedge funds are a really interesting type of fund. In 1949, sociologist Alfred Winslow Jones had the idea of building a portfolio that would make money when certain stocks went up by, buying those stocks, but also make money when certain stocks went down through a kind of investment called a short, where you borrow stocks, immediately sell them, and then buy them back later to return them to the person you borrowed the stocks from. So if the stock price went down, you buy those stocks for a cheaper price than you initially sold them, therefore making a profit. Jones called this combination of buying stocks like normal and shorting stocks hedging. And with hedging, even if the whole market crashed, you could still make money. And you can't do that without shorting. Now, regular funds, the kinds that anyone can invest in, are restricted by law from doing these weird, complicated financial things like shorting, because ordinary people's retirement savings are in them. And therefore, the government puts a lot of limits on what the fund managers can do to protect the people who invest in them, to make sure that they're going to have money for their retirement. But hedge funds get around these restrictions because they're only open to really, really rich people who don't need that same kind of protection from the government. Hedge funds typically charge 2% of the money they manage, plus they take 20% of any profits the fund makes through its investments. So that's hedge funds. Now I'm going to teach you how to run an institutional fund. Every institutional fund starts out with an investment policy statement, a document that sets return objectives like we want to make 8% every year on what we invest, risk limits like we should never lose more than 15% in a year, liquidity requirements, we need to be able to get $100 million in cash from selling off investments right away if we needed to, time horizon like, well, forever if you're a university endowment, or the 30 years you have until your employees retire if you're a pension fund, and permissible investment categories like stocks and bonds are okay, but cryptocurrency is not okay for this portfolio. And a committee approves all that and reviews it every year. A third-party custodian bank like State Street, BNY Mellon, or Northern Trust holds and keeps track of the actual physical investments separately from the investment manager to prevent all different kinds of fraud. At some point, there is performance attribution analysis, which means looking into the portfolio to see how the portfolio did. Did it make money? Did it lose money? And why? For example, maybe you found out that the reason it beat the market is because it invested a lot in energy stocks and energy stocks went up a lot. This way, the board can know if the fund manager or managers did a good job or a bad job, whether they should be fired or maybe given a raise if they did a really good job. And throughout that whole investing process, knowing all the information there is to know on companies, knowing what the researchers out there are saying, all of that's really important. This really, really, really valuable data is delivered through advanced computer software like FactSet to buy-side investors. And the demand for data keeps growing and growing and growing like crazy. Today, fund managers use millions and millions and millions of pieces of data every day to do their jobs. And beyond standard financial data, like a company's stock price or its revenue last year, 63% of buy-side investors said last year in 2025 that they plan to increase spending on getting alternative data. For example, satellite images of store parking lots to see how a retailer like Walmart is doing before they release their earnings numbers. Yeah, things are continuing to get very, very interesting on the data front. And this isn't even mentioning all of the rapid recent advancements we've all been hearing about in AI. Let's take a look at the current state of institutional asset management. Total assets managed by the world's 500 largest asset managers reached $139.9 trillion at the end of 2024, a 9.4% increase from 2023, the year before. North American managers account for $88.2 trillion, or 63% of the total. In 2024, the money in U.S. passive funds surpassed active ones for the first time in history. $19.1 trillion in passive versus $16.2 trillion in active as of October 2025. Over the prior decade, only 21% of active funds outperformed passive ones. Proving Cowles right once again. Now, I started to touch on this in the section about David Swensen and illiquid alternatives, but while there are public companies where anyone could trade their shares like Apple or Amazon, there are also private companies whose shares are really hard to get around. You got to actually go to the owner. It could be a family business, a smaller company, or it could even be a pretty big company that just doesn't want to go through all the hassle of going public and selling all these shares. There's also all these legal things you have to do. Public companies are required by the government to put out a bunch of data about them so that everyday investors can know what they're getting into. But private companies don't have to do all that. And after the 2009 financial crisis, banking regulations required banks to keep more cash and lend out less money to make sure that they always have cash on hand for the people banking with them. But banks used to be one of the biggest ways that these private companies could get money loaned to them, as they can't get bonds out there the same way that public companies can. So these private companies still wanted loans, aka credit. So institutions set up funds full of loans to private companies that people could invest in. These kinds of funds, known as private credit funds, grew from about $310 billion in 2010 to $3.5 trillion by 2025, a 11-fold increase in just 14 years. As of 2025, 94% of institutional investors have money in these private credit funds. And private investments as a whole, so also including equity in these private companies, these kind of investments now generate about 4 times more profit than traditional public company investments. So recently, investing in private companies has been a huge opportunity. There's just a huge demand yet to be filled for financing these private companies. And there's a lot of money to be made. Also, private companies share the information about their company, for example, their revenue, in very inconsistent formats. And a lot of the information out there on them is really subjective. And I think that's creating a huge demand for people providing information about these companies and for people that can decide which companies are smart investments with the little amount of data out there. So, from 17th century Dutch businessmen pulling their money together for Asian voyages to funds using satellite images of parking lots to make investments today, the purpose of the institutional buy side never changed. Just like ants build bridges together to get to the other leaf, people put their money together in big funds to have it go into investments that they could never make on their own. As of today, about $140 trillion are inside institutional investment funds. And in recent decades, we've been undergoing a shift from active management to passive management. And now there's this new interesting movement of more and more money going into private companies, which have introduced a lot of interesting opportunities for investors, but really only for those that have the information, that have the data to make smart investments in these companies, which is why today it is really important to have the best data and the most up-to-date data, which is why it is crucial to have a tool like FactSet if you want to make good investments.